Trading liquidity is hard and complicated as most traders say so. I will show you step by step how to make it simple, so you can get setups like you see on my chart. So let's get started. So down to its simplest format. Liquidity indicates orders on the market. So basically buying orders and selling orders. And our main goal using the concept of liquidity is to identify market areas where large amounts of buying or selling are taking place on a certain market at a certain time. Now, one of the best ways that we would do this is by finding what the basic retail trader is looking at. That's one of the simplest ways to identify retail liquidity on the market. Things like support, resistance, and basic trend lines. So looking at this example of a market that follows a downtrend currently, we can see there is a resistance level here at the top. Many traders see this, especially unexperienced traders. They see these areas as levels where price would reject to the downside. They basically cannot see the price continuing higher. So that means that they will sell short once this resistance is retested. Now, us knowing that there is a large number of traders selling short there, we can also assume that these traders likely have their stop losses around above this level. Because it makes sense psychologically, as I said earlier, these traders can't see the market going above the resistance, so it would make sense for them to place their stop losses on levels where they don't believe the market can move into. Now we also have another type of trader, which is the breakout trader. These traders are looking to see the market push up into new highs by essentially breaking up out of the resistance. Then they will look for a retest of the area and a continuation towards constant higher levels. So this resistance has in the first place stop losses from the sellers, and as well as buy stop orders from the buyers that see this move as a breakout into a potential trend continuation. So when we have an area where there's many pending orders in the market, these are the areas where significant reactions generally will happen. Just like in this example, we know there's a huge amount of orders at this level. So if the market can move towards this level, there is going to be a lot of orders getting opened. And this creates a battle for liquidity by also trying to convince traders to sell short the market on the resistance. But what we will often see is quite different. It's pretty rare that the market just breaks, retests, and pushes higher so perfectly. But rather, a lot of the times, we will see the market sweep the swing highs, move into the levels where orders are situated. Of course, because the market usually moves towards liquidity, and liquidity is most often met on swing highs and swing lows, and rarely between the middle of trading ranges. And once that liquidity is swept and those orders are filled, we then see the more significant movements in the market. So on the strategy that we are going to be trading, this is the exact plan that we are going to follow. Basically, we are going to look for price levels where liquidity is being swept. In this price action scenario, we are looking at equal high being liquidated. And on the other type of scenario where the market is reversed, we look for equal lows being liquidated. There is also liquidation of swing levels, and as well as liquidation of internal levels. However, we are going to talk more about them into the charts. The second important concept we need to understand is market structure. So the market structure can either follow an uptrend, that is represented by a market constantly forming swing higher highs and swing higher lows. Then there is a consolidation movement. That is basically a market that is moving sideways, essentially forming equal swing high and equal swing lows, and we also have downtrends, a market movement that forms swing lower highs and swing lower lows. Now, the most simplest plan is to simply hold buy long positions when we see the market following an uptrend, and holding sell short positions when we see the market following a downtrend. Most traders avoid trading consolidations, and for a good reason, mostly because we cannot know for certain where the market will break out of the range. However, with the strategy we will soon talk about, we will be able to see few trading opportunities on sideways trading ranges. And that is because liquidity play a huge role in these consolidations. Now, to plan the entry and position itself, this is what we will look at for the setup process. So basically, what we are looking for is for a market to shift its trend in the first place. So let's say here, where initially we got an uptrend formed from higher highs and higher lows, but then the market actually fails to hold above the last higher low, and it breaks below. Now this break is what we call a market structure shift. And this just indicates that the market has reversed from a bullish standpoint to a bearish one, which most of the times the market will form a lower high. And this is the level where we will most often look towards sell short positions, into essentially taking the market towards new lower lows from where we can take profit. And for the opposite scenario where the market initially follows a downtrend, That is formed by lower lows and lower highs, when the market fails to form a new lower high, and instead it breaks above the last lower highs and basically forms a higher high. This move is also called a market structure shift, and this shows a trend reversal from an initial downtrend to a likely upcoming uptrend, and we will look for buy-long setups when the market pulls back down to form higher lows, level where our buy-long orders get triggered, and we look to close the position with hopefully take profits towards higher highs. We will meet these two scenarios in all cases because market structure is fundamental to this strategy, so make sure to understand these concepts well. And the last concept for this strategy is supply and demand. Supply and demand refers to levels in the market with high interest of buying or selling from smart money. A demand zone is taken from the last candle before a significant move to the upside, and demand zones only take place in uptrend markets. Now, what a demand zone tells us is that this was a discounted price for traders to buy from, so this is seen as a good price level for traders to buy. And these are usually the institutional traders, and the traders with very large capital that can impact market movements. That is why we see significant movements out of these levels. So we see that buying took place here in large amounts, which caused a big push towards the upside in the market, and then the market pulls back down. And the theory says this is a discounted price and it's seen as a good level to buy from. So when the market comes back to this area, we will see another push of institutional buying, which will cause a large upwards move. Now, a similar step-by-step process goes for the supply, but instead of a buying area like we had on the demand, this is a selling area. So in a supply zone, we are looking for the last candle before a significant downside movement. That is what forms a supply zone, and this is then seen as a premium price to sell from. So traders are looking to sell here on the supply because they see this price level as being overpriced, and they'll be able to profit from a movement towards the downside. The theory works the same, just flipped on the other side. So once the market reaches this premium price level, we will be looking for selling opportunities. Now, supply zones are only valid when the market follows a downtrend. And remember that demand zones are only valid if the market follows an uptrend. So the way that we're going to be implementing supply and demand in the strategy is quite simple. We're going to be using it in line with market structure after we see sweeps of liquidity around ranges, swing highs, swing lows, equal highs, and equal lows. Basically, the liquidity patterns that we discussed earlier. And now let's put them all together and talk about the setup planning itself, right into explaining the strategy, and after we will be testing it on the charts. So the trading system step by step is as it follows. We first want to analyze market structure to basically understand what trend the market is following. In this case, this market is in a downtrend. Then we identify where does liquidity rest on the market, and we wait for a sweep of the liquidity. In this case, the market swept the equal lows. Then we wait for a market structure shift externally or internally, moment where we will look for supply or demand zones near the pullback, depending on where the market structure has shifted. In this case, the market has shifted to an uptrend, so we'll be looking for demand zones. We place a buy order on the demand, with stop loss below the demand, and take profit on the next liquidity that needs to get swept. That can be the external swing levels, or even internal levels, if the risk to reward is getting decent enough. Similarly goes for the other scenario, but here we have equal highs taken as liquidity instead of the equal lows. And in this scenario, the structure shift happened to the downside by forming a new lower high, so this means that the market has shifted into a downtrend. In this case, we'll be looking for supply zone near the pullback, with a sell position on the supply, stop loss above the supply, and take profit below swing liquidity levels, or internal levels, if the risk to reward is getting too high. And that is basically it. Now let's jump into the charts. So let's check this market. The first step, we analyze market structure. The price started with an upwards impulse, followed by a pullback to the downside. Then internally we got an upside push, a downside pullback, another upside push, and pullback again, which is soon followed by an external upwards movement that breaks the highs. So we need to closely pay attention to external structure, and as well as the internal structure too. On the internal structure, we got these higher low formations here, and here, and we also got higher high formations up here. So internally, the market followed an uptrend. Basically, the market got aligned with the external structure, which also was following an uptrend. But the most important structure in here is this break of the past swing high. This is what we call to be a break of structure. Break caused from the market continuing its uptrend. So after the last upwards push, we also got a downside pullback. Now also pay attention here to the internal structure. Because we can see that the price has swept the last low with a wick, let's make it more clear to see. So we can easily see the liquidity sweep now. And as we know, if the market makers sweep downside liquidity, it's because they prepare the market to push it to the other side, which is to the upside in this case. And sure, it did that, because it has kept the uptrend structure of higher highs internally, but also externally too, caused by a large upwards movement. This upwards move breaks up the last swing high, so that means that we got another break of structure, and that shows that the previous trend has continued. Now let's move into what has happened next. And as we can see, the market kind of started to consolidate, moving sideways, without breaking any important swing level. Basically, the trending market has stopped for now. All we can see is formations of equal lows and equal highs. Now we are able to see on the chart that soon after, the market broke down the equal lows. And because the trend the market was following initially was an uptrend. This break is a market structure shift that flips the market into a downtrend. Now we need to pay attention to the upcoming price action. So this move was caused by a downside break of the equal lows in an uptrend, which in itself is one sweep of liquidity. But also when the market pulled back to the upside and then broke down the lows, we got the first bearish break of structure of the downtrend, which is shortly followed by a break of the past internal highs. Usually in downtrends, highs are not supposed to break into higher highs, especially when the momentum and volume is favoring downside movements. So there we got another liquidity sweep, this time on the highs. And after the liquidity sweep, the market crashed downwards, and forming another bearish break of structure. Now we've entered into the most recent price action, and because we confirmed a downtrend, what we would expect from market structure is to form a swing lower high, followed by a swing lower low, then the same structure, so basically a constant cycle of bearish breaks of structure with lower highs and lower lows. Now we need to ask what caused this massive downside movement. We need to closely look at the candle right before the aggressive move started, and that is the candle that forms the supply area. Now we would place a sell short position on the supply, with the stop loss above the supply, which also coincides being right above the last swing highs, and structurally we would place the take profit below swing lows. But because the risk to reward is way too high, at least for me, I would place it slightly above. 1 to 3 or 1 to 4 can be enough when the swing structure is way too far. And now we wait to see if the market approaches the supply. So now the entry got triggered and moved right in to take profit, closing the position as a win. Now also we can pay attention to what happened right after. So we can see here an ascending trend line. We use that as a liquidity area. The price action also forms lower highs, which is the strongest form of showing that the market has not enough strength to break into new highs. So we can actually replicate the plan from the past trade. We draw the supply zone from the last candle before the large downwards move, placing the entry on the supply with stop loss above and take profit below the internal lows. We are basically expecting the market to break the last internal higher low into making lower highs, just like it is supposed to do in downtrends. Also, don't forget about the trendline liquidity, where there is many stop losses below this trendline. Entry got triggered here, and this position takes a lot of more time than the last one. But what matters is that it closed on a win instead of a loss. If we zoom out, we see that it broke below the internal lows, basically taking stop losses from there, and currently is doing the same thing on the next internal higher low, and it will probably do the same thing for the lowest level as well, and after that, the market will probably see an upside pullback at least on the lower time frames. Let's run another backtest. So this is the gold market on the 5-minute time frame. The first step is to analyze the market structure, and starting from the beginning of the price action, the market initially pushed upwards internally, then pulled back down on a higher low, pushed upwards again, then massively pulls back down into new lows caused by a large downside movement. Now we need to closely pay attention to swing levels. In here at the start, the market was actually in a small uptrend on the internal structure on a lower time frame. See the higher lows. But then it actually failed to create a new swing higher high. Instead, it formed a lower high. This is a huge sign that buyers are losing strength and sellers are ready to step into the market, which is what happened a couple minutes later. A massive downturn that flips the market bearish. So, continuing the analysis, after the local low has been set on the last downside move, the market pulled back up, then broke into new lows by pushing even lower. So we got another swing lower low, which is then followed by a small upside pullback. But the pullback ends lower than the last pullback, meaning we got lower highs. So far, we've got a pretty bearish market. Let's see if something changes because we can see that it later turned into a slow kind of uptrend. But we need to understand very well why it happened and what does it mean. So if we analyze the external structure from the last lower high, the market pushed back down again. Then buyers started gaining strength back into the market, which caused a slow increase of price. So we need to pay attention to swing levels. We've got a higher low and a higher high. Now, because we were before in a downtrend, and the market broke above the last highs, this is, as I said earlier, a market structure shift towards the bullish side, which basically flips the market from a downtrend into an uptrend. Uptrend that has constant internal higher highs, which leads the price into new external higher highs. But also, if we look at the new low on the recent pullback, we can see that it did not break it down. So we actually got a swing higher low, higher than the last one, a bullish sign on the swing structure, which is shortly seen after, because the market started a rally to the upside, a very bullish price action recently. And also do not forget that before this rally, the market was pulling back down on the swing structure. And if we look at the swing highs before, they broke it to the upside, meaning this is the first bullish break of structure after the market shift. And that was externally. We can also look at the internal structure as well. For example, we see here on the pullback that the market formed constant internal lower highs, up until this level, where it actually broke above the last internal high, basically forming an internal higher high, and being the first liquidity sweep of the highs on an internal downtrend. This is a market structure shift that flips the internal downtrend into an uptrend. So we've got a bullish break of structure on the external structure, and we also got a bullish market structure shift on the internal structure. They both show a flip into an uptrend, a very strong confirmation of the trend. Now we can basically look at the last candles, because based on the analysis, knowing that the market is in a strong uptrend currently, we can look for demand zones. And here we have this large candle, larger than the candles next to it. Applying the demand theory, the demand is the last candle before the larger candle, which is this area. So now we can look for buy setups on the demand, with stop loss below the demand, and take profit around 1 to 3 risk to reward ratio. 1 to 3 at most. I would look for 1 to 4 setups in more intraday type of trades. And now we essentially wait for the market to come back into the demand. Here the entry got triggered and we entered the position. And after filling the demand, it almost instantly rejects it to the upside and finally moves into the take profit target. Now let's run into a final backtest. This is on the Dow Jones index. Starting with the market structure analysis. The market initially pushed to the downside first with larger candles, but then as the market decreased, the smaller the size of the candles have printed on the chart. This shows a loss of selling pressure. Basically, sellers are losing strength, and the structure formation is a lower low, with a lower high. But then because sellers started losing strength, buyers came into the market and pushed it very aggressively to the upside, again with very large candles, this time showing massive buying pressure. Here we got the internal market structure shift, because the market broke out of the internal levels, which later formed that massive upwards movement, and we also got the external market structure shift, so both show a strong uptrend, but then the market has failed to keep that buying momentum, and the price pulled back down, which is normal and expected after such a massive push to the upside. The important structure is that we got a swing higher low. This holds the uptrend by protecting the lows. Then moving on the recent price action, especially on the internal one. We got a downside movement, a pullback to the upside, another downside movement, another pullback, and then again another one. Basically having lower high formations with lower low formations, so a bearish price action on the internal structure. A structure that didn't held too long because shortly after, the market again continued the uptrend on the internal structure, with yet again, large-size candles. Now this upwards movement breaks the last lower high, which forms a new higher high. But keep in mind on the internal structure. So this is an internal market structure shift. And because the internal trend was following a downtrend before, now it has flipped into an uptrend. Make sure to not confuse the external trend with the internal one. The external trend is bullish. The internal trend was bearish from the last massive upside movement on the swing trend, up until now when the price broke above the higher lows. Then we got a small pullback to the downside and a continuation of the highs by breaking to the upside. Now moving into the most recent price action, we got here equal highs, and down here we got equal lows. So essentially, a consolidation movement. Now, as I said in the earlier minutes of the video, consolidations have massive pools of liquidity above the resistance, and as well as a lot of liquidity below the support. So one way to understand how to trade with the trend is to identify liquidity and entry structures. For example, knowing that the move before the consolidation was a large upside movement, we can look for demand zones before the consolidation, and applying the theory. The demand zone is situated on the last candle before the larger movement to the upside, which in this case is this candle. The demand is also validated from the presence of a bullish break of structure that has basically broken the market to the upside into the recent highs that we see on this market. So if the theory is valid, they should target the lower side of liquidity first, and that can fill the entry on the demand zone. So we are looking to buy long on the demand, stop loss below the demand, and take profit at around 1 to 3 risk to reward. See the liquidity sweep of the support. That fills the demand and takes off to the upside near instantly. Now let's see if it actually moves into the take profit since it's pretty close. So the market basically took out the liquidity of these swing highs. It's what I was mainly looking for. Now for the most risky setup, there was also the option to take out the highest liquidity point, essentially the extreme swing high. Now based on the backtest, the position is already closed, but with this buying pressure, there is a good chance the market could also sweep out the highs. And it actually did. It's very important to read buying and selling pressure based on the size of candles. That's it for this video. I have extra resources on the link on the description. My goal is to get as many traders as possible into becoming funded traders. If you liked the video, subscribe and leave feedback in the comments. Thank you for watching.